Okay, so in this part of the structured course, we're going to talk about gaps, Globex, and opening auction, and apply the logic that is what is happening during this time. But before we do that, let's discuss how, as professionals, we do not use open, broad statements such as gaps will always fill. We know that it is a live, ongoing market, and that gaps aren't what market makers and size traders really consider. It's about the supply that's in the market and the stuff that we discussed in the other classes. So I caution you that don't fall for the traps of these made up rules that are made up by retail traders. Okay, so moving on. So we know that stocks and equities are a basket for like the S&P 500, for example. And we know that the serious traders in the market operate from 9:30 in the morning to 4 o'clock in the afternoon Eastern Standard Time. But we know that future stocks moves after hours, like once the market is closed. So who is in the market during that time? So we know that market makers are in the market at that time, and they could be selling their inventory that they bought at the close. Maybe day trade margin wiped out some pretty big size traders and took them out of the position and took the price down to a lower price. And then before the market closed, market makers went down there, restocked their inventory, and then during Globex, they're going to move the market back up higher and sell what they bought at the close. And we know that market makers restock their inventories during Globex. We know that market makers, start building the position for the next day in Globex. So a lot of things are happening in the Globex market, which is from market close to 9:29 the next day. We also know that, sophisticated proprietors or dynamic traders trade at night as well. However, usually you get the weaker traders who don't have like the confidence needed or just can't handle the volatility of the regular trading hours. Okay, moving on to opening auction, right? Opening auction, think of it as a storage bin of orders from the Globex activities, right? So I like to think of it like traders are building the agenda overnight when they can't trade, but they're placing limit orders based off of, earnings or news events or, wholesale actions during the night, and then the storage bin is then executed at market open, right? And we know that market makers, especially the lead ones, get to see the order flow before the market opens, because they have to provide the liquidity for it. So they get to see any serious selling, right? Because they have to buy it, right? And they also get to see any serious buying. Why? Because they know they have to sell their inventory or short the retail to provide the liquidity needed in those orders. But as retail, we don't know what type of order flow is going to happen at opening auction. So when opening an auction happens, for us, it's like releasing a pinched garden hose. We don't know where it's going to go. So that's why it's important to let the order flow just settle down, because we know that order flow is going to lead to some pretty violent moves sometimes, and there's going to be a lot of volatility. So now let's talk about what gaps are. And gaps are when we open from yesterday's high or low, we open outside of yesterday's range, like the previous day's range. It's not yesterday's close, it's not yesterday's open, it's we either gap up, which means we open from yesterday's high, or we gap down, which means we open below yesterday's low. So let's start off with the scenario where we gap up, meaning we are opening at 9:30 in the morning above yesterday's high, right? And we open outside of that range. So if we are gapped up, there is a scenario where we trap the longs and selling happens and the gap fills, so we return back to yesterday's high, and like no upside over the overnight will happen because we'll fill in the gap. We have supply in the market, because just like single prints, to the upside, short. We know that we have a short position, and that short position has buyers that need to buy to close their position, right? So if we open higher and we know that we are starting to come back down, we break open and we start filling the gap, then there's enough supply in the market to satisfy the buyers in that gap, right? Now, if there isn't enough selling at the open, there isn't supply, and that short position stays and the gap doesn't fill, right? And let's say we can't fill that gap and we can't break the opening, that means wholesale has their position already and are willing to move it up higher. You must remember this. Remember, if we gap up and cannot fill the gap and break below the open, wholesale has a position from Globex and they will move it up and sell it for a profit. Now, let's say we gap down, right? Which means we open below yesterday's low, and if we can't go back up to fill the gap to the upside, then what that is telling us is that there's supply in the market that needs to be filled. If we do go up and fill that gap, then that tells us that supply is shut off and that we can expect higher prices. And why can we expect higher prices? Because we know wholesale bought their position before the market opened, turned supply off, and is taking it higher to sell it. Now, let's say we open within yesterday's range and we don't have a gap whatsoever. That means wholesale is going to be choppy until wholesale can build their position, regardless what time they do this during the morning. Remember, this is just guidelines of structure. It's never a guarantee. All right. Hopefully this helped. Later.